Welcome back, grade 10s. Now let us look at our third concept for this lesson, which is personal liability company. The meaning of a personal liability company is that a personal liability company is mainly used by associations such as lawyers and accountants, etc. There are others as well that use the personal liability company. So one thing that you need to understand with a personal liability company is that a group of people who work in the same field, they are the ones who decide to choose and come together and start a personal liability company. The name of the personal liability company ends with INC. So in order for you to be able to determine which form of ownership is a personal liability company, you would see the name of the company ending with INC. Then that will be a clear indication that it is a personal liability company. Let us look at the characteristics of a personal liability company. Directors have unlimited liability and they are jointly liable for the debts of the business, even if they are no longer active in the office. So the characteristic of a personal liability company is that directors have unlimited liability. It simply means that directors' personal assets can be seized to pay for the debts of the business, even if those directors are no longer in office, they are no longer working for that particular company, but they will be liable for the debts that they have caused in a personal liability company. The Memorandum of Incorporation should state that it is a personal liability company. So obviously the MOI, which is the Constitution of Companies, it has to state that this form of ownership is a personal liability company. Now the advantages and disadvantages of a personal liability company. You need to note, learners, that the advantages of a personal liability company are the same as those of a private company. The disadvantages of a personal liability company are also the same as those of a private company, except that the directors of the personal liability company have unlimited liability. What I've said, that the directors' personal assets of a personal liability company, they can take their assets to pay for the debts of a personal liability company. That's why we say they have unlimited liability. And let me remind you, learners, when we talk of directors, we are referring to those people that have been voted for by the shareholders to manage the company on their behalf. Let us move on to our last concept of the lesson, which is the public company. Definition of a public company. A public company is a company that is registered to offer shares and stocks to the general public through the JSE in order to raise capital. So when we talk of the public company, we are referring to the company that is registered with the Johannesburg Securities Exchange to offer their shares to the general public. They offer their shares so that they can generate more capital. Ownership of a public company is distributed among shareholders through the free trade of shares and stock. So obviously the ownership of a public company, it is distributed amongst shareholders in terms of what? In terms of the shares that the public is buying. If you have 50% of the shares in a particular public company, then it simply means that you own 50% of that company. So that's how it is distributed. That's how the ownership is distributed, Moving on to the characteristics of a public company. A minimum of one person is required to start a public company. So it's easy to start a public company because it only requires one person. One person can start a public company. The company name ends with letters LTD. So with a public company, the name of a public company must end with limited or LTD. So any form of ownership that you see or any business that you see that it has a name and then ends with LTD, then it simply means that that particular business, it's a public company because public companies end with LTD. Shareholders have limited liability and are not personally liable for the debts of the business. So what does this entail? It simply means that When they say shareholders have limited liability, it simply means that shareholders' assets cannot be seized to pay for the debts of the company. Hence, we say they have limited liability. The debts of the business belong to the business. They don't belong to the shareholders again. Then, advantages of a public company. The public has access to information, and this could motivate them to buy shares from the company. So obviously in a public company, they have to publish information. They have to publish it in the newspaper. So obviously with this information being available to the general public, then it motivates people to go and invest, to go and buy shares in a public company, because information is being published. They are able to see what is happening with a public company. Shareholders can sell or transfer their shares freely. So in a public company, shares are freely transferable. Shares are freely sold. So there are no regulations in terms of selling shares or in terms of transferring shares to somebody else. So that's another advantage of a public company rather. The business has its own legal identity and can own assets or property. So when we say a business has its own legal identity, we simply mean that a business is registered in its own name. Since it is registered in its own name, that particular business, which is a public company, can buy assets using the name of the business, can own properties using the name of the business, because the business is registered. Not to say they have to use the owner's name to buy shares or to buy assets rather, or to buy property, but we use the name of the business because the business is registered. Then let's look at the disadvantages of a public company. Auditing of financial statements are compulsory. So here's a disadvantage. Financial statements of a public company, they have to be audited, which again, it's going to be a disadvantage, because when you audit financial statements, you need to pay for auditors. That amount of money could have been saved and maybe invested somewhere as surplus profit, but because it's a public company, they have to be accountable to the public. Financial statements have to be audited. It is compulsory. Some shareholders may not exercise their voting rights, resulting in choosing the wrong person as a director. Another disadvantage is that when it comes a time when shareholders have to vote for the directors, people who are going to manage the company, some shareholders might decide not to exercise their voting right, and the wrong candidate can end up being appointed as a director of the company because other shareholders decided not to exercise their voting right. Directors may not be motivated to work very hard because shareholders decide on the directors' remuneration. So obviously the remuneration of the directors is being decided by shareholders. So the directors may not put more effort in terms of managing or making sure that the company becomes a success. So it ends up demotivating the directors, since they are not the ones who decide how much remuneration they should be getting, but it's a call from the shareholders. I hope that today's lesson was fruitful and hope to see you again next time. Goodbye.